Hey, everybody, it's Thursday, and in case you've forgotten, that's right, it is episode 72 of the Real Deal Pod with Allister and Geoff. I am your trusted realtor, Allister Carrington, and, it took a lot, but he's been freed from the gypsies. The ransom has been paid. It only cost me 3 goats, 5 chickens, and a giraffe. But I got my main man, Geoff Lee, back here by our side, our trusted broker, our mortgage guru. Geoff, I don't want to have to tell you the amount of favors I had to call in to get that giraffe. Let's not, I don't want to get us down that rabbit hole, but buddy, it's nice to see you back. You're looking good. They fed you. The gypsies fed you.
Yeah. And you know what? It will be the only giraffe that will be in Italy. So it's I don't know what you
Gonna make money, baby.
I don't know what you did to get it, but good on you and thank you. Yes.
You're welcome. Freedom. You're free. How was it, Geoff? How was your trip, man?
Yeah, the trip was good. It was 2.5 weeks of sunshine, good company, good people, architecture, wine, food. Yeah.
What was your favorite part?
You know what? I've been asked that, and there was so many favorite parts. There wasn't one bad part, right? Obviously Italy and exploring Italy with my girlfriend and another couple was a great part. It was nice that we went with some seasoned travelers of Italy, and they kind of were our Sherpas, where they had organization as far as what we're going to do each day. We had reservations to fantastic restaurants every night. We were tasting the traditional food rather than, your traditional Italian food in the West here.
You mean the real stuff as opposed to
the real stuff like
Hawaiian pizza?
Pork cheek and beef cheek and sea urchin and, lamb and rosetto.
Risotto, you mean?
Panicotti. Like there was just, I don't even know how to pronounce half of this stuff, but it was a true culinary experience as well, which was pretty cool. The architecture there obviously speaks for itself. These small, well, not small towns, but these Madeira, for example, is one of the oldest civilizations in the world, where people were living in caves since 1950, which is now getting kind of, obviously they're no longer in caves, but that whole region is getting rejuvenated. Yeah, it's pretty cool. Pretty cool. I would definitely looking forward to going back. And I was a little disappointed leaving. So.
Well, that means it was a good trip, man. Yeah. That means it was a good trip. Well, we're all happy to have you back, buddy.
Thank you.
And Italy, I hope you enjoy that. Gypsies, I hope you enjoy that giraffe.
Yeah, it's gonna be a moneymaker. They put that on a petting zoo or something. It's gonna happen.
Yeah, I'm telling you, man. I'm telling you. A lot of favors. Awesome. Well, man, let's not waste any time. Let's get kicking, baby, with podcast's hottest segment, and that is...
Did you know?
Did you know? That is right. So, Geoff, did you know, as I'm trying to pull it up here, did you know that here in British Columbia, thousands of condo owners could soon be hit with some pretty hefty special levies? So, so here's the deal. BC has some of the lowest average monthly strata fees in Canada. We're at about $470 a month compared to roughly $650 in Ontario, which, for people sounds great. But here's the thing. The lower the fee might actually be setting up owners for a financial shock down the road. See, the problem is how our strata corporations are funded in BC. Stratas only need to put 10% of their annual operating budget into a contingency reserve fund. And that was actually a new thing that was put in place. That's just, that 10% is just recent, right? So basically the rainy day account, so basically for listeners out there, the contingency fund is the rainy day fund account for major repairs. In Ontario, though, their contributions are tied directly to future capital expenditures, which means they're actually saving for what is coming. And the result is, according to a Vancouver-based company called Octo AI Technologies, the average reserve contribution in BC is just $75 a month compared to $210 in Ontario. So that's almost 3 times less we're putting in to our reserve funds. So that shortfall, it doesn't just disappear, it shows up later as the dreaded special levies. Octo AI admits that 135,000 BC condo owners will face a special levy averaging nearly $7,500 per unit this year. So let that sink in. 7.5 grand, and that's the average. So for many owners, it's become so common that experts are joking special levies aren't really special anymore. They're just expected. In fact, the average homeowner needs to budget about $2,000 a year every year for the next decade to cover them. And if your building is older, it's closer to $3,000.
Wow.
Yeah. So now the province is trying to fix this. As of November 2023, which I was saying it's just been recent, right? Stratas must contribute at least 10% of their annual budget to reserves. And as of July 2024, BC eliminated the option to defer depreciation reports, which was a big thing that condos were doing. Meaning all strata corporations now have to get a professional report every 5 years that forecasts their building future repairs and replacement costs. So these depreciation reports are key because they show what needs to be replaced when and how much it will cost. It's, of course, the financial roadmap for every building. And for buyers, it's a goldmine of insight before you write that offer. Property management companies like First Service Residential say that they're already seeing improvement. Over 95% of the buildings they manage now have up-to-date depreciation reports, up from just 60% a few years ago. And their clients' reserve funds are stronger than ever. So while no one loves the idea of higher strata fees or paying for depreciation reports, the move towards stronger reserve funds is actually good news for BC condo owners, and it means fewer surprise bills, healthier buildings, and better financial stability across the board.
Well,
so that's my did you know, Jeff?
Can you sum it up for us in simple language?
In simple language, we have a problem with special levies. We have the potential of 135,000 BC condo owners that will face a special levy this year, averaging out at about $7,500 per unit.
Wow.
Yeah.
And that's going to be ongoing.
Ongoing while we're now starting to build up the reserve funds with this 10% increase that mandate that they put in, the depreciation reports now having to be done every 5 years, but it's because they were pushing them back,
right,
and not paying attention to them. The kicker here that the one thing that I want people to think about though is that homeowners now, right now, if you're buying a condo, you have to be prepared to budget about $2,000 every year for the next decade to make sure to cover for special levies. Yeah. Right? And if your building's older, that number is probably going to be about $3 grand. That's one of the biggest key takeaways out of there is the budgeting that you're going to have to do.
So just so I'm clear that condos, not all condos, but condos have basically been deferring the depreciation reports.
Yes.
Now it's going to be mandated that all depreciation reports are going to be for all strata units.
Yeah, it was done. That was done in 2024. It has been mandated, so it's been a year.
And then it's going to, and then it has determined if there's a deficiency in the contingency reserves.
Yes.
Based on the improvements that are suggested within the depreciation report.
Right.
So this regulation that's coming out is for strata units, be it 2,000 or 3,000. Is that what you said? 2,000 or 3,000 a year?
No. So the mandate was put in 2024 that condos and townhomes. So keep in mind this is also townhomes too, but any stratified properties, that they have to have their depreciation reports done every 5 years, and they had to come up to date. So they had to, everybody had to rush out and get one done. But what it's found though, is that because here in BC, we've tried to keep our strata fees so low that there isn't enough in a lot of the contingency funds in order to do a lot of the upcoming repairs that are scheduled in these depreciation reports. Right. So a lot of these units are facing this year, right? Just this year, 135,000 condos are facing special levies on average of $7,500.
Yeah, just to bring up the contingencies to where they need to be.
Right. Well, and get the repairs done that are going to need to be done.
It reminds me a little bit of the trigger point and the trigger rate, right?
Right. Hey. Right.
Whereas, the prime rate has gone up. You're in a static variable rate payment. At some point, that rate has come to a point where all your payments going to the interest. Nothing's going towards the principal. Now the financial institution is coming in and saying, "Hey, we need an X amount of dollars to bring everything back in line." So this is very similar.
Very close. It's very close. Yes. And that's the part that I think I can't understand how we missed the boat on this by kind of saying, "Oh, we're gonna charge you $470, $35 of that is going to go into building up the contingency fund. The other 435 is going towards the interest," right? And not operating like the Ontario, as they used for the example, and tying it directly to future capital expenditures, right? That's the part that I don't understand that miss.
Yeah. Well, I think it just comes down to poor management, right?
But across the board in every strata across British Columbia, and it's not just one strata company, it's not just one property management company, it's all, right? Yeah. So it's us as a province not having proper regulations, right? Yeah. Not having proper regulations in place.
Or provincial management.
Go figure. Go figure, right? But that's my did you know. So everybody out there, when you're buying a condo, it's the strata fees, right? Aren't the most important thing anymore, right? Yeah. It's not what am I paying for strata fees. It's what does the contingency fund look like? And even when just to quickly pause on that before we get into Jeff's thing, strata contingency funds that have a lot of money in them, that's not necessarily always good, folks. Okay? Because what that could, if your realtor should be reading the minutes, because what that could also mean is they're not spending that money. So what it means is they're not doing any repairs. So they've got we've got a contingency fund of $400,000. But then when you read through the minutes, they haven't been doing any repairs. And then when you look at the depreciation report, you see that there's a whole lot of things coming on the books that $400,000 isn't going to be able to cover, and you're still going to be hit with a bunch of special levies. So everybody understand that all three things now tie in: your strata fee, the contingency fund, and that depreciation report. What does that all look like? All those three things tied together. It's not now just based on that single leg of what is my strata fee payment.
Which is a very good segue into what I want to talk about with the new regulations that are coming up or come 2026 in the first quarter from the Office of the Superintendent of Financial Institutions,
Okay.
also called OSFI, right?
Yeah,
So,
just to keep it short for everybody.
well, people will always hear OSFI, but they never know what OSFI is. It's actually probably a quiz question that we should have when we do these presentations. But OSFI
Right.
pretty much is the superintendent of financial institutions. So pretty much the boss, right?
Right.
And there are new rules that are rolling out in the first quarter of 2026. And I wanted to kind of have a discussion of what our interpretation of what those rules are. There's a lot of misinformation that's going on. And what I wanted to talk about today is what our interpretation as far as what these rules look like. And I guess my question to you, Alistair, are you aware of what some of these rules are and how they're kind of spooking people? Like, have you heard much about them? Because the reason why I asked, they have
Yeah.
just recently rolled out. So some
No,
people
I was
are
gonna
fully
say
aware
to
of
be
them,
on.
some
No,
people
I was
are
gonna.
not.
Yeah, I was gonna say to be honest with you, no, I'm not. I'm not familiar with a lot of them.
So one of the things that are coming out within these OSFI regulations, there's verbiage within the regulation that it makes it sound that real estate investors are about to be locked out of financing.
Really?
And what it's really, really important to understand that is absolutely not true. Our interpretation of the regulation is that it's a financing of investment of properties are still going to be in effect. So you can still, as an investor, purchase properties, but lenders applying some new behind the scene rules that may affect on how these mortgages are categorized or are priced on the banking side. So it's really important for people to understand that these are new capital rules for banks. They are not rules for borrowers. And there's a lot of information that these are rules that are coming out that are going to handcuff investors in purchasing investment properties. So that is the one thing to understand, that is not true. Like what is happening, similar to there being more proactive than reactive to your did you know, is that they're setting up guardrails and not barriers, and they're just making sure that there are new capital rules for banks moving forward when it comes to investing in properties.
Now, just a quick question. Is there any insight as to why they're putting up these guardrails? Like what was the reason? What was the cause for them feeling to have to do this?
Well, and we're going to jump into that.
Oh,
So
okay.
the key points is that these are capital reserve rules for banks. Now, people are
Okay.
going to say, well, what are capital reserve rules, right? Everybody will always say, oh yeah, okay, but a lot of people don't understand what a capital reserve rule is, and that's really when financial institutions set money aside for long-term strategic planning, right?
Okay. Yeah.
So again, these are banking guidelines that are coming in, and we're going to get a little bit deeper into the understanding of the capital reserve and why the capital reserve. But again, I want to note that these are not new borrower qualification rules. These are banking regulations. So it's going to determine on how much money banks must keep in reserve to cover potential losses. One of the riskiest investments for banking is investment properties and business for self people, right?
Yeah.
So these capital reserves are basically always put into place, and it really outlines a little bit of money that's being put aside for banks to keep in case of these potential losses. So what is happening is that banks with these regulations coming in have to put more money aside in their capital reserves when it comes to investment properties and investment mortgages.
Okay.
So again, borrowers can still qualify with rental, excuse me, with rental income. This hasn't changed. But again, this is a regulation set by OSFI, which is the Superintendent of Financial Institutions, to ensure that a safety net of banks have to maintain in order for them, in order for if these losses are to incur, they're not going to be impacted. So it's a safety net. Um, just kind of going off some notes here. You can still use rental income or personal income to qualify for an investment property. There's a lot of misinformation about that. Again, this is a bank adjustment that affects on how lenders manage their balance sheets. It's not how they're going to assess the ability to borrow. Again, there's a lot of misinformation on that. And if this rule makes lending less profitable, basically lenders may become more conservative with investment property products. So what that really means is that lenders are going to become a little bit more conservative about what type of properties they're going to lend on, what rate that they're going to give you, because if it's not profitable for a bank, are they going to lend on it?
Right. Yeah.
So again, the other thing that they've been talking about is this 50% income producing test. And here's another thing that is being really widely misunderstood. So here's what this rule looks like. If more than 50% of the income, this is your rental income, is used to qualify, and it comes from the property itself, the bank must classify that loan as income producing. So again, this does not mean that you're not able to qualify for this. That does not mean that there's financing that's not available. What this means is behind this, the banking scene is that if 50% of that income is used to qualify is coming from the rent, this now has to be classified as a loan, as an income producing loan. So again, this is an internal accounting label for banks. It does not block financing. It does not change your eligibility. It simply affects on how banks record the loan for the regulator. So I'll give you an example, Allister.
Yeah.
Someone is going in and they want to purchase a fourplex. Okay.
Right.
And the bulk of the mortgage to qualify is coming from the rental income, more than 50%. If you have to use more than 50% of that rental income to qualify, it is now going to be labeled or classified as an income producing loan. Okay.
Right.
That's what it means. So it means the bank holds more capital. And what that means when it becomes an income producing loan, this is when it comes back to the capital reserves. This means that the bank now has to hold back more capital in reserve in case the financing collapses and there's going to be a loss. So what that really means is that the bank is putting more money set aside for these income producing loans. And at the end of the day, if it's not going to be profitable for the bank is going to become very conservative in the type of lending that they're going to do with investment properties.
So is this because they're fearful of, let's say, of somebody foreclosing of that property, somebody not being able to rent it out, not being able to afford it anymore, and then having to foreclose on that property?
Well, again, when they're putting money in the capital reserve, and a lot of people haven't realized is that lenders are always putting money in capital reserves for long-term strategy and planning. Right?
Yeah.
So again, one of the highest foreclosure rates that we have in Canada, which aren't many, do come from investment properties. And this is again part of that long-term strategic planning, right? So what this regulation is now doing, Allister, is that it's regulating that if you are in an income producing property or an income producing loan, more money has to be set aside for capital reserve, which then means that that's more money for strategic planning in case of foreclosure, but then that's less money for the lender to be playing with in the front end, because it's basically sitting in the back end, strategic planning, if something is to go sideways, along with a whole bunch of other things that could go sideways outside of foreclosure.
Sure.
So again, why are people, and this is answering more to your question, why is OSFI making these changes? It's really to protect Canada's financial system, right? With interest rate instability, right? Where are interest rates going? We have high consumer debt. Look at our real estate market right now. It's the quietest it's been, or the second quietest it's been.
That's why I was asking this, is because I think that they don't have a lot of confidence in the market, and I don't think they have a lot of confidence in the market repairing itself in the next little bit. And this is why a lot of this, that's why I asked that question if they were afraid of foreclosures, because you've seen so many rental units hit the market, right? A lot of people have put all their condos up for sale and all of that sort of thing, right?
Well, again, it's really preparing the banks for turbulence.
Yeah,
I have a very good friend of mine. He's a developer.
yeah,
And he completed his pre-sale, and they did all their pre-sale sales, and yes, some collapsed, and most completed, but they didn't sell all the units because, again, a lot of developers, they'll section off a certain amount for pre-sales, and then they're expecting the market to be a little bit, to be on the high side when they complete, so they have a whole bunch of units that are basically going to be sold in that market.
yeah.
Do you know how many units were sold in this development in 2025?
No.
One.
What?
One.
Wow.
So again,
Right.
this is just an example, but can you imagine if this was happening on the whole on the banking side?
Right.
And again, we don't have enough in the capital reserve to go through that turbulence. Guess what happens to our banking system, right? And we've seen this down in the US.
Yeah. Yeah. Yeah.
So again, this is a scary conversation. It's kind of being misunderstood throughout our industry. And again, this is our interpretation. So I'm trusting that we're not misunderstanding, but this is a banking guideline. This is a banking regulation. Yes, it's going to impact borrowers, right? Because again, as far as what has to be set aside for capital reserves, what has to be set aside if it's deemed an income producing loan. And what that really means is that it's guidelines put into place being proactive in what OSFI or what the higher powers may feel as far as where our market is going, and they want to be proactive versus reactive.
Right.
So again, so by tightening up on how income is counted and how loans are classified, OSFI then reduces the risk of banks overstretching themselves. Again,
Sure.
becomes preventive. A more cautious banking system obviously benefits everyone. Who wants to go through the banking system of what the US went through? And this
No.
includes, being cautious with borrowers. It means cautious with the type of rental properties people are purchasing, because again, it ensures that the flow of the credit doesn't freeze during downturns. So again, it's another one of those things that our banking system is being proactive in, and it's preventive maintenance, and it's creating a stronger bank today, which means fewer surprises tomorrow.
So that's what I was actually going to say. And I've said this before. Here in Canada, we have well, it was always noted as the third. I don't actually know where we sit right now, but we were most of the time noted as the third most conservative bank in
Yeah.
all of the world. And the reason, and that was one of the reasons why Canada was looked upon so glowingly in how we handled financial crises, was because we had a conservative bank that did make that was prepared for these types of things. So it doesn't really surprise me that they're doing this. It actually makes me happy that they're doing this, because you do not want turbulence in our financial institutions, man. We do not want what happened to the states in what was that, 2008, right?
Yeah.
And the hell that they went through, because they were giving mortgages to anybody. People were saying, I'm a massage therapist and I make $85,000 a year,
I
and they
think
were
people were actually getting mortgages for their pets.
yeah.
That.
Yeah. Yes, it's crazy. I remember watching a lot of that on 2020 and stuff like that. It was in 60 Minutes and stuff like that. It was insane. So yeah, so no, it is good. But it is good that it's really good that we're laying it out, because I can see how investors, would become extremely fearful, say, like in hearing some of this, as to them, what, I'm not going to get a mortgage for anything anymore, or it's going to cost me, when the rate's 3.9%, I'm going to be paying a rate of 7, right? Because I'm an investor. I can see how they might be,
Well, I don't think it will be like, hey, if the average rate out there is 4.5, and now you're going to be paying 7. I don't really see that, but
no,
this is what I want to kind of, lift the fog. Did OSFI make life harder for investors? I'm going to say yes, because there's going to be more rental documentation that's going to be required.
sure,
Rental income is going to be treated a little bit more cautiously, and there are going to be qualification um, tightening up. I think there will be shifts in what that rate is going to look like. But again, these are all measures of being conservative and moving forward with investment properties. So again, understand, folks, the highest foreclosure rate in Canada, and we have a very low foreclosure rate, are investment properties. They're not primary homes. So again, this is one of those things that OSFI is being proactive in to say, hey, interest rates are all across the board and unpredictable.
yeah,
Like one day they're going up, one day they're going down. We are in a cooling market and in a market that has been cool for probably, I think these are your words, Alistair, the longest that the country has ever seen, right? As far as how long it's taken to rebound,
mhm.
right? And we just want to make sure like that our banking system is going to be um, ready for this type of turbulence. Again, we have the highest consumer debt that our country has ever seen, right? So again, I'm with you. I think in conversation and when you hear this through media outlets, when you hear this through social media, it makes it sound like basically OSFI is making it impossible or handcuffing investors to buy, which is not the case.
No. And just to tag on to that though, just to tag on to that, and I don't even believe that it's making rental investment difficult. I think what it's doing is it's having the people that should be rental investors continue to be rental investors, and the ones that shouldn't and that shouldn't, OSFI saving them from themselves, right? Because there's a lot of people that did sit there and just say, hey, I'm going to go buy this place. I'm going to over leverage myself, much again like what happened in the United States. I'm going to go over leverage myself, become a landlord, have all of these rental properties, and I have no idea what I'm doing, right? And then crises comes and can't afford them and then have to foreclose on everything, right? So they're saving people from themselves. So I don't know if it's making it harder. I just think it's leveling.
Well,
It's just clearing up the playing field.
and in short, it's these rules are targeting banks' capital management, right? And not the borrower's ability to qualify. And
Right.
this is the biggest misinformation that's out there.
Hmm.
And again, is it going to be harder to qualify? Yeah, probably. Um, is it gonna? But again, this is not a regulation that's coming out to say that, hey, if you're an investor, you can't buy anymore. The
Right.
financing is not available. Again, this is a banking guideline. It's targeting on capital management, capital reserves, and how they're being managed. And this is what that is. So again, really, really confusing. Like most media outlets, like most print outlets, they're going to sell you that fear part of it. And it's really important that people who are listening reach out, give me a call. We can lift the fog, re listen to this post, check out the blog that we've written on it. But again, even take this one thing away and the one thing away is that these rules, again, are targeting capital management in regards to the capital reserves. They are not targeting you, the borrower, the ability to qualify or purchase investment properties. And I think I'm going to leave it at that.
That was great, man. No, that was great. And I think that is just people to notice there are people to take note of. They're not saying no to lending, right? It's the easiest way for us to say it. They're not saying no to lending on investment properties. Really, what OSFI is doing is saving the banks and people from themselves by over leveraging, right? That's really what it comes down to. So it'll still be, the opportunity will still be there as long as you meet the new guidelines and whatever those turn out to be, right? It's much like with the stress test happened, right? Everybody thought, oh, nobody's ever going to be able to buy a house in Canada anymore because there's a stress test.
It did handcuff purchase power by 25%.
It did.
People still figured out a way.
No, but that's what I was just going to say. That's what I was going to say at the beginning, right? Yeah, it did cause some people to not be able to afford, and it did, cause some people to reset their financial roadmap, right? But at the end of the day, everybody figured out how to work within the rules, right? Within the new rule. It didn't kill anybody, right? It didn't kill the real estate market, right? I don't believe it killed the real estate market. I believe that COVID killed the real estate market, right? We're just coming down from 3 years of craze, or 2 years of craze, right?
It's the COVID hangover. I think
that's what it is. It's a COVID hangover. But we all figured out how to work within the guidelines of the stress test, and this is just something again that we'll be able to work within the guidelines of, and what's most important is that we stay educated about it. Right. And we don't fall into the fear mongering that we might hear from, like Geoff said, from the media outlets, whether it be print, whether it be television, or whether it be our friends. Right. So when our friends start speaking about it and saying, oh, guess what I heard, and this, that, and the other, ask them when they became a lender.
Well, and I'll be honest, when I first heard, like, if someone sent me a video on it, YouTube video that someone in our industry did, and it did sound to me when I listened, is that, oh my Lord, if you're an investor, you pretty much might as well kiss it all away. You're not going to be able to buy, and
right.
That was my first impression based on information that was being sent by somebody within our industry. So this is where I go back, is that if that's my interpretation, and I've been doing mortgages for well over a decade,
yeah.
A common person that doesn't do this every day, when they hear this, I can almost guarantee you there's going to be some misunderstanding in what's being delivered, or if it's being delivered, it's being misunderstood as far as how it's being received. So again, like I said, this is not going to limit borrowers from buying investment properties. It may make it a little bit more challenging. This is basically a regulation for banks on how they do capital reserves and how they manage that. So there you
just go. Another reason to make sure that your power team is just that, a power team, one that's knowledgeable, one that's informed, and one that can steer you in the right direction.
Yeah. Amen.
That's it. Oh man. All right, folks. That's it, man. That's episode 72. I think that was pretty good after a 3-week layoff. Was it 3 weeks, Geoff? Felt like years without you, man. Yeah. Felt like years without you. I missed you. Is that a song?
I don't know. It is now.
If not, it should be. That's awesome. Well, everybody, thank you all for listening. We missed you. We're happy to be back. Join us again next week for episode number 73. In the meantime, continue to love, like us, share us, tell everybody you know about us. Send us your comments. If any of this stuff that you heard today, like the OSFI stuff, concerned you, or the fact that you might be one of those 135,000 condo owners that's facing a special levy of $7,500, if you got any concerns, that's crazy, man. If you got any concerns over anything like that, please don't hesitate to reach out. We are always there to help you guys. As we always say, we have doubled down this year, and this year is almost over. My God, it's flying down. We doubled down this year on making sure that we deliver the most valuable content we can to you guys. So,
73 episodes, holy smokes.
Right? That's crazy, man. That's crazy. Well, until next time, folks, stay empowered, stay informed, and most importantly, Geoff,
stay tuned.
That's right, baby. Stay tuned. Peace out.